This is Retirement News Online. And we've said it before, the stock market is not the economy. Usually this simply means that fluctuations in the markets may have little to no real bearing on the underlying realities we think of as making up the economy. Joining me is Zach Abraham. He's a radio host and chief investment officer with Bulwark Capital Management in Tacoma, Washington, who often says in the time of COVID-19, the stock market couldn't be more divorced from the United States' broader economic situation. Zach, thanks for talking with us. Why do investors often confuse the two, the stock market and the economy?
You know, no matter how many times we repeat this, the average investor, the average person out there, if they want to know how the economy is doing, they look at the stock market. You know, most of them, it's weird for us in the industry. The funny thing is, it's even true with people in the industry too. But if you're a fundamental investor like I am, you look at things a little bit differently. So you're looking at it and you're going, wait a second. I don't believe in imaginary things. I don't believe in Peter Pan. If we believe we can fly, we can fly. I approach things more in the Socratic method. You know, what are the facts, things like that. What you quickly realize is that's not what most people do. Most people look at the stock market and that if the stock market's up, there's two things that they infer. The retail guy believes that the stock market is right and the economy is coming roaring back. And they will continue to believe the stock market over other pieces of economic data because the stock market is the one piece of data that they understand, right? Market up, good. You know, you put the other day, the market rallied big on an ISM reading of 56. People go, oh, that's the highest ISM reading we've had in the last year and a half. And we laughed when we saw that and we went, that's horrible news. And even guys in my own office were like, what do you mean? How could that be horrible? And I go, guys, the ISM measure, it works differently than what people think it is. It's not an absolute value metric, meaning the higher it goes or the lower it goes, the worse it is. That's true to a certain degree, but it's all relative, meaning when the ISM reading is at 50, okay, that means that it's not changing. It's not growing. If it's below 50, it means that manufacturing is contracting. If it's above 50, it means that manufacturing is expanding. Okay, well, back in March, you had the largest drop in ISM in a month on record. All right? So if you come out now and you're posting an ISM reading of 50, that isn't good. That means that you're staying where you're at, right? You took this big hit and you're neither growing nor expanding at 50 and you can't get out, right? You're there. So a reading of 56, while it's the best in the last year and a half, by definition, because of the historic drop in ISM, if we were just getting back to normal, you should see ISM readings above 60. They should be taking off like a rocket, right? Because they got to rebound us to the level that we were prior. Well, 56, it's slight growth. That's the best reading we've had in a year and a half. So what is that telling us? That this isn't that strong of a bounce back. But people don't know that, right? They just see 56, best reading in a year and a half. Oh, great. The economic recovery is coming back. Oh, the unemployment rate's at 8.6%. They're not looking at the seasonal adjustments and the hedonic adjustments that we're looking at. And furthermore, they're not looking at the U6 number. And furthermore, most people, even in the industry, don't know the difference between the two. Right, so they're just looking at stocks. Everything's good. And so, I think that I don't know what it's going to take to pop that bubble, just because it's just the most bizarre environment in the world, Scott. You've got, historical economic weakness and historical damage done economically, and yet stocks couldn't be better.
Can you give us your take on what the economy might look like after the election? For example, what happens if Trump is reelected, or what would happen if Biden becomes president?
I do think that the market reaction between Trump and Biden has been overplayed, meaning that whoever gets elected is going to crank the stimulus like you can't believe. And that's what's driving this. It's not presidential policy. I think if you get a Biden election, I think, if Biden gets elected, I think things might be a little bit tougher, but I don't see it really changing anything because Biden's going to spend just as crazy, if not even more crazy than Trump. And so to me, that's the story, right? As long as this can go, as long as the insane levels of stimulus can go, and the Fed and the U.S. government keep trying to perpetuate this false environment, And that's another thing that I don't think is getting enough play is that, what the biggest difference in this environment in the past, the U.S. government and the Federal Reserve tried to prevent or slow down asset bubbles. Both the Federal Reserve and the U.S. government are sponsoring this asset bubble. And as somebody that's a skeptic of this market and the economy and sees things the way that I do, you can be as skeptical as you want, but you need to respect that fact that if those in play think that, asset bubbles are no longer a problem and they can control it and they want to jack this thing as high as they possibly can, hoping it has positive feedback loops that lead into the actual economy, then, will that work over the long run? Of course not. It never has. But over the short run, it sure can. And you have to be respectful of that. You've got to be respectful of the fact that stocks do not represent fundamental things. And until they do, again, path of least resistance is higher. Our fear is the fear that I think every balanced and measured investor should have, which is, you're tap dancing on a trap door. You don't know when this will stop, but when it does, you got a really, really long way to fall before, these types of stocks and these markets represent any sense of historical value. And so I really don't see the presidential election being very pivotal. I don't think Biden is stupid enough to raise taxes. And that's the only thing I could see him doing. I don't think Biden's dumb enough to do that. I think he'll talk a good game to his voting base. And when he gets in, he's going to be looking at those U6 unemployment numbers just like we are and say, hey, guys, we can't raise corporate taxes in this environment, but we can print. So I don't really see that big a difference, honestly.
That's Zach Abraham in Tacoma, Washington, and this is Retirement News Online.